What if you could play Monopoly in real life and start by buying all four corners of the highest foot traffic intersection in one of the most desirable neighborhoods in the entire Midwest? In this deal drop, I'm breaking down how we are acquiring 11 off-market properties in the central west end of St. Louis, Missouri, with a strategic plan to turn $10 million of limited partner investment into a $200 million trophy portfolio. My name's Walker Diable. I'm the Wall Street Journal bestselling author of Buy Then Build. I've acquired 8 companies outright, and I've started a private investing movement. This is not a deal pitch. It is a masterclass in how we're building generational wealth block by block. Let's dive in. Okay, today we're going to talk about legacy. I'm super excited, as always, to have a deal drop. But this one in particular has just been months and months in the making. And, I was realizing this morning as I was finalizing the slides, it was actually 1 year ago this week that we launched the first deal drop in Carlsbad, California. And not only was that fun and a success, but ultimately, the people that are in that deal today have, doubled their money on paper, and we're actually teed up, or I should say on track to go public in that company next year. So, these are exciting things. I'm trying to, cherry pick deals that I'm obviously investing in, that I want to bring to the community that we can invest in together and ultimately build our own family office, which has been maybe the most fun I've ever had, seeing all of these, different tracks in my life kind of culminate into one place and being able to bring our community together for fun and profits. Okay, so today, guys, the agenda is pretty simple, okay? It's pretty simple. We are going to play a game and have some pizza, all right? Then we're going to take a walk in one of my favorite neighborhoods in all of St. Louis with some friends. And then ultimately, we're going to talk about building legacy and how we are going to do something really cool and really fun. But here's the thing. I don't want you to wait 20, 30 minutes for me to get all through this. I'm going to give you an advanced peek into the deal right now. So this is Kyle Howerton, okay? And Kyle lives in St. Louis, has been in St. Louis, and is a, how would I describe Kyle? He's let's call him a real estate visionary, okay? And his vision is ultimately to build a real estate development company and management company that's $1 billion in assets under management, okay? Kyle believes, and I believe, that there's enough opportunity in our local market to be doing this just there. And despite, the visionary look on Kyle's face, I need you to understand he's really just a super cool guy, okay? The way that he's wanting to build this company, okay, is to source off-market deals, okay? The most unique off-market deals in his words, and also go after the best ones, okay? Then he wants to unlock maximum risk-adjusted returns, and he wants to lift up the communities in which we are investing in, okay? So we're going to get into some of that today, but how is he doing it? How is he doing it? He's doing it by arming the AHM team with a stack of expert partners, okay, who have worked in every facility, every asset of real estate capital, management, and construction, okay? And so AHM is the team that's been, put together in order to execute on this vision, all right? Now, this team has been hard at work, and what we're going to talk about in terms of build legacy is something super exciting. We are closing on 11 off-market properties next month, okay? And this is in the single most desirable neighborhood in the entire Midwest, okay? Further, we have a playbook to magically turn a $10 million investment, equity investment, into a $200 million neighborhood revitalization over the next 10 years, okay? And this ultimately is what Build Legacy 1 is gonna be, okay? It's basically to acquire and build a $200 million mixed-use real estate portfolio in the trophy neighborhood of the Central West End in St. Louis, okay? There's limited partner and co-GP positions within the fund, okay? So when the fund is buying, value add acquisition properties, we as the fund will be the LPs. However, there are ground up opportunities to be had. And in those situations, we're going to be co-GP. And what that means is that our money goes in alongside the GP. We just don't have to sign the personal guarantees. We don't have to do any of the work. And we participate passively at the GP level on the ground up. Now, there's both 10 and 12% preferred returns available and a 5x multiple on the projection. This is a 10-year hold, guys. It's a 10-year hold. It's a long time, but it's a big revitalization project, which you'll see in just a second. I have to cover a disclaimer. As always, we're going to have, forward-looking statements. We're going to make projections that are 100% wrong no matter what. I've never seen a projection that's, correct to the dollar ever. I can't give financial information. I've just been, investing my money myself and doing things like this. And so I'm sharing, consider this entertainment purposes only. This is not a solicitation to sell securities and all of the other disclaimer things that are ultimately be an adult. You can always lose money in anything you do. Life is risk. Own it as I do and hang out with us if you want. So here's the deal. All of us have played Monopoly. Okay, everybody on this call has played Monopoly. If you don't know what that is, get off the call because I'm going to lose you. Okay, but here's the thing. Playing Monopoly and winning Monopoly are two totally different things. Okay, they're two totally different things. It takes more than just luck. All right, it's about aggressive strategic control and cash flow management. All right, and what we're going to do right now is break down the 7 steps that you need in order to win at the game of Monopoly, okay? So first of all, buy everything you land on early in the game, okay? And I think we all figure out this first step pretty quickly when we're kids, right? Like in other words, your friend buys everything up and like you don't, you're like saving your cash and you're waiting for a boardwalk or whatever and like it doesn't work out. And you're like, okay, I need to just like buy properties. You need to like get on the board, right? Like that's step 1. You need to get on the board to get some properties. It's all about acquisition, not optimization. Just get out there and buy stuff. Okay, that's step 1. And if you don't do that, if you don't get in there and buy assets, it's not going to work out for you and you're going to be one of the first ones to lose. That's step 1. Step 2 is a little less obvious. And you have to go a little deeper, okay? When you look at the Monopoly board, what are the spaces that everybody wants? What are the properties that everybody wants? I don't even need to tell you, if you're familiar with this game, it's Boardwalk and Park Place. Everybody wants the premium spots, right? But here's the truth about Monopoly. If you ever notice, it's actually hard to buy them. And the reason it's hard to buy them is because you don't land on them. And that's because statistically, there's other spots on the board that people actually land on, okay? And those spots are over here. It's the orange and the red. These are the high traffic spots, okay? Specifically, Illinois Avenue is the #1 spot in the whole Monopoly board. And second and third are all right here in that corner. Not only does it have to do with like the roll of the dice, okay, and the different combinations that get people there, but it also has to do with the fact that there's a lot of cards and there's a space that gets people to go to jail and then ultimately they roll out and end up right in those spots, okay? Here's the point. Orange and red are cheaper to get into, okay? They're a lower cost of building out properties on it, and it's got high traffic. So you've got a fast ROI, moderate build cost, and a high hit frequency. It's actually exactly the spot that you want to be in if you are playing to win, okay? So don't go for the premium spots, go for the ones with the traffic, all right? Third, step 3, build 3 houses as fast as possible. All right, the reason for this is we need to increase the value of the locations and the properties in which we own, okay? So once you actually own it, you need to increase the value, and the 3 home is the sweet spot of being able to maximize revenue for cost. Now here's the other thing that advanced people know. Advanced players in Monopoly know that there's actually only 32 houses in the game. So by buying houses, specifically 3 on each property, okay, they're eating up and constraining the supply, which is restricting other people's ability to get the same property, to get that same asset, okay? So there's a fixed amount of houses, just as there is, say, in real life, okay? Number 4, use trades to create monopolies. So in other words, don't be afraid to trade out of properties that you're not gonna be able to get a monopoly on in order to gain monopolies and build strengths that are going to be the ways to win the game. Okay, so you want full color sets, not quantity of properties. Once we get into it, okay, that's the mid game. Number 5, okay, create a mortgage machine. All right, so in other words, don't be afraid to use debt. Okay, don't be afraid to use debt to build up your key assets. Okay, because having liquidity for survival and building out the assets that are most important are more important than owning undeveloped spots that aren't necessarily going to, win you the game and build those inroads of pain into our opponents. All right. 6, your jail strategy evolves. Okay. So early in the game, we want to get out of jail. We want to pay to get out of jail because we're still in acquisition mode, right? We want to be able to buy as many assets, as many properties as we possibly can, because that's the game in the early. However, by the time we get to the end of the game, something happens. What happens is every time you're out of jail and you're moving around the board, okay, you have to pay other people rent when you land on their spots. But if you're in jail, at the end, you're actually keeping costs low and increasing your revenue as the other players are moving around the board and hopefully landing on your spots, okay? So you evolve your jail strategy, okay? Finally, you want to optimize for the grand finale. And what this means is you want to focus on building value in the high impact monopolies that will maximize the revenue to you and cause the most pain. It's a board game, it has limits. And cause the most pain, okay, to other people, right? But ultimately, Monopoly takes a long time to play, okay? And most people will not play it long enough. And so if you just are willing to play the long game, what happens is other people will give up because they're playing the 3 to 5 year game. They're playing the quick turn game. And you are here to win. And you want to own the whole thing. I have one question for you. Have you ever wanted to play Monopoly in real life? Let's back up just a bit. A lot of you guys, I know you, you know me, I'm Walker, but this invitation went out to 85,000 people. And so there might be people here who don't know me yet. And so let me take a minute to introduce myself. My name's Walker Dybel. I've acquired 8 companies over the last 19 years. I'm a minority owner in 24 more. Okay, I've had 3 startups. I've had 3 exits. I'm the founder of Acquisition Lab. I'm the founder of Build Wealth, which is one of the things we're doing here today. I've been inside 100 transactions, either as the buyer, the seller, or the M&A advisor inside the deal, okay? I formerly was a partner with Quiet Light, where we brokered online businesses. I was an adjunct professor at the Owen School of Business at Washington University in St. Louis, where I started the Entrepreneurship Through Acquisition program. I have an MBA. I was formally licensed by the SEC. I've got every single, private market accreditation out there, and I've been called a thought leader of the year by a bunch of people that do things like that. I've written a bunch for a lot of these and have been, featured in a lot of these places: Forbes, Inc., Fast Company, most recently Yahoo Finance, which was when I knew I had made it. I also wrote the single best-selling book in the world on buying small businesses. Forbes liked it. Wall Street Journal, USA Today bestseller. It's been a best-selling book on Amazon every single day for like 6 years in a row, I think. So if you haven't checked it out, I spent a lot of time on it. I hope you like it. Look, what the thing is buying companies and teaching people to buy companies ultimately led to me forming Acquisition Lab. And it's been, probably the most satisfying experience of my life, because ultimately we're a truly vetted community, and we've been able to help hundreds of people acquire companies, usually their first, now totaling about, almost $500 million in small business acquisitions. And that's very satisfying, because when you buy a company, it's really the fastest way to real wealth for most people. And I always say, like, if you want to make $1 to $5 million, buy a company and run it for 10 years. Okay. That's probably the best way to do it, and go all in, all the rest of it. But the thing is that, like, having gone through over 1,000 people inside Acquisition Lab, everyone has different versions of the same question, which is sort of like, Walker, how do I not make a mistake, right? How do I buy a business and not make a mistake? And I think that, ultimately the challenge is that when we're going all in on a single asset, right? That's the type of concentration that enables entrepreneurs to make a lot of money, but it's also taking that risk and putting all your eggs in one basket that can be very risky, right? And so the textbook method of de-risking anything is diversification, diversification. And so I started sharing the pizza by the slice strategy. And I've been doing this really since 2013. Started buying companies in 2006. And what I realized was that every time I bought a company, I was buying like the whole pizza, right? And taking responsibility for the whole pizza and all the employees and all the management and all the downside and all the upside and everything. And I realized private markets work very similarly to public markets, right? And you can buy minority pieces of publicly held companies or public assets like real estate, oil wells, credit funds, whatever it might be, venture capital if you're a little, like that. And ultimately, it's buying pieces of a company or pizza by the slice that enables us to build portfolios. And as I started sharing these strategies, which ultimately became Build Wealth, I ended up building this pizza portfolio over time, right? And I started sharing what I was doing. And the thing is that I realized that some entrepreneurs are ready for this. Some people want to buy a business. Some people have a business that they've started or acquired, and they're looking to diversify in the private markets. Other people are just really high earning W-2s. And the thing here is that like they shouldn't necessarily go rogue and just buy their own company unless that's what they want to do with their life. And really, there's sort of like an 8-year plan, an 8-year strategy where you can build your own pizza portfolio, okay, and get yourself to financial independence and then make that final leap, okay? And by doing that, that's the strategies that we share here. So this is the pizza portfolio that I built by putting equal investments into acquisitions, okay, as I was making, so between $100,000 and $200,000 typically. And I was accelerating my wealth growth rate passively and significantly faster than just buying one company and lifting it by myself or, with our team. This is what became Build Wealth. Now, there's something else I need to share, which is when you look at what it takes to get truly wealthy, okay, there's actually a chasm that you end up having to get across, okay? And let me explain. If you take the net worth, okay, of U.S. individual, this is what you get. This is what you end up with. You've got about 8%, okay, that have $1 million in a net worth or higher. You've got just under 4% that hit 5 million, so about half, okay? But then just to get to the top 1%, that takes $13 million in net worth, okay? However, here's the thing. If you're a millionaire and you have between $1 and $5 million, okay, you're like 97, what is this? You're like 97% of all millionaires, okay, are under 5 million. And millionaires, everyday millionaires are kind of stuck, right? They're kind of one big event away from disaster, or they're small rich. Like we've gotten wealthy enough, but we haven't gotten to that next level, right? And we start to look at how financial advisors tell time, everyone knows that it takes $30 million before you're considered ultra high net worth, ultra high net worth. And what that means is you have true generational wealth in order to, invest in, family office style investments, okay? Now, here's the thing that I think is super interesting. Once you get to 20 million, you could actually, oh, sorry, you're up here, and this is high net worth, right? But once you get to 20 million, you can like go to sleep and get to 30 million, right? You just invest your money and like live long enough and you'll be fine, okay? And you've got an 80% success rate. I'm surprised it should be higher. Maybe it's because it takes people their whole life to get to 20. But like, most people that end up at 20 or 30 million, they either have the inside playbook or they had a single business exit, okay? Okay. So the big gap that I actually want you to do is I need you to focus on getting from 2 million to 20 million. This is the chasm that I need you to cross, because this is the hardest one. Once you have that first $1 million, which is incredibly difficult, once you get there, crossing the chasm to 20 is the little thing that makes the big difference in the money game, okay? But the thing is that if you want to be an ultra high net worth individual, you can't invest like the average millionaire, right? So we need to look at how do ultra high net worth individuals invest. And they invest okay, like this. This is Tiger 21's asset allocation portfolio, okay? They are a group of high net worth individuals. The average, they say it's like 20 million, but it's really most closer to 30 to 40 million is the rumor. So, up here, you'll see that they've got, 54%, over half their money in private real estate and private equity, okay? Now, if you're the average millionaire, where's our money? It's down here in public equities, right? And we might have, a little fixed income or whatever. Ultra net worth people have credit funds, but we have bonds, but it's like the 60-40 portfolio or whatever your financial advisor has you doing, right? So we're like way down here. This is our whole pie and this is their pie. Don't you see the difference? If you have a $1 million net worth, or you make, I think it's 300,000 annually, married, then you are considered an accredited investor, and this whole pie opens to you. And that's what makes this so exciting and fun. But if you look at, who's run the playbook on this, right? David Swensen was the #1 endowment manager. And he did so well by investing in alternatives that they ended up calling it the Yale endowment model. Okay. And what David Swensen figured out was that liquidity is way overvalued. And the thing is once you have a certain amount of liquidity, you don't really need it because you're investing your money. And so allowing your money to be illiquid for periods of time in order to get outsized returns was exactly what entrepreneurs were doing one at a time. Okay. David Swensen was doing it with the endowment model with multiple slices of pizza. Okay. And so he ended up doing about 73% in alternatives. So, hedge funds, venture capital, private equity, real estate, natural resources. So, oil and gas. And he probably had some credit funds in this fixed income. 73% is pretty close. It's a little light compared to what we saw in the Tiger 21 allocation, but it's very close, right? It's very close. So I've been doing a disciplined approach to diversified private market investing since 2019. And ultimately, I started investing in these in 2013. But ultimately, what I found was that whenever I was inside a deal and doing a deal, there was always a capital stack, right? And the capital stack had senior secured debt, and then, these people were, why were they in the deal? They were in it because they were senior secured, they had collateral on all the assets, and they were getting principal and interest payments every single month, okay? Whereas the entrepreneur and the equity holders, they had the common equity, so they weren't getting that cash flow, but they were getting all of the upside, okay? The bank doesn't participate in that. And then you had some people in the middle, whether it was pref equity, mezzanine debt, or whatever, and I ultimately created my model, the wealth stack, because it allowed me to make sense of like, okay, we're told, go get a job and invest in the stock market, right? Well, in the private markets, the equivalent is buy a business or start a business and then take all of your extra in savings and put it into, private credit, private real estate, and private equity, okay? This is the wealth stack. It's active and it's passive. And this is the game that both maximizes returns and gets you diversification, okay? Usually at the cost of liquidity, all right? And so if you go back and look at the sort of deals that we've taken out, this is what we've been doing. So we've got our first deal, we're about 14, 16 months in. We're still targeting, we're on track for a 49% internal rate of return. Second deal, we're actually doubled our money on paper, but like it's going to take longer. So that, I don't know if that was on purpose, but I don't know if that growth rate is going to continue at the same rate. We're doing fine though. Third is, all these are on track. So this is 30 to 35. This one will probably be, who knows, I think 13% by the end of the year. This is a semi-liquid cash flowing credit fund that pays monthly if you want, or compounds faster than the stock market. And then 28 to 25. Basically, the point is we're getting 24 to 37% internal rates of return on our portfolio so far, okay? Now, Walker, this is all so great. Thanks for telling me about your background and what we're doing and the portfolio we're building together. What are we talking about today? Guys, this is St. Louis, Missouri, okay? This is technically downtown West. Some of us are familiar with the new soccer stadium and this downtown West environment. Here's the arch down here. This is St. Louis, Missouri. If you look at St. Louis on a map, it looks a lot like this. And so you've got the river on this one side, and these are all of the cities, all the neighborhoods in St. Louis, Missouri, okay? And what I want you to focus on is this one right here. That is what's called the Central West End, okay? And this is, let's zoom in on that. Great. This is the Central West End map, and this, my friends, is what's going to be our monopoly board. So let's dig in to why that is, okay? First, let me show you what's holding this neighborhood in place. To the east, okay, we've got St. Louis University and Midtown, fabulous Fox Theater, so you've got all of this to the east. Then you've got downtown west and now called City Commons. That's where some of our other investments are happening right now. To the west, we have Forest Park, which we're going to talk about, huge natural resource. We have downtown Clayton. This is where I live and work, and where Build Wealth is, and ultimately it's where all the M&A advisors are in St. Louis. It's the second highest rental rate, second in the Midwest, second only to Wacker Drive in Chicago. We have Washington University in St. Louis, the #1 law school in the country, as well as ranked engineering, business, law, etc. Then to the north, you've got the Del Mar Loop, which is a big student area, highly populated, vibrant area. And down to the south, you've got the Grove neighborhood, okay, which our team actually played a very important hand in rehabbing. You also, to the south, have access to Highway 40, okay, which is the main vein of transportation for automobiles in all of St. Louis, okay? Now, if you look at Central West End, this is what it looks like today, okay? And the thing with Central West End, it's very dense, okay? It's a very dense neighborhood, all right? It's very walkable. This is the type of neighborhood where you can, get a haircut, see a movie, get a coffee, go out to, a great restaurant, go, wherever, and go to work and home, and you're walking all the time. It's got a lot of green space, right? It's a very beautiful place, right? It has luxury shopping. It's got coffee shops, it's got restaurants, it's got bars, it's got, world-class ranked restaurants here. You've got a very lively street culture and street life, okay? So it's very active. There's a lot going on here. We have an independent bookstore, for crying out loud. Who has that? Remember that? Guys, we have the World Chess Hall of Fame in the Central West End, okay? And you might be thinking, Walker, really? Like chess? Yeah, guys, chess. Like international competitions in the Central West End, okay? And we have architecture to die for. We've got brand new, like very sexy, high rises. We have turn to the 19th century, homes. Look at these like brownstone, townhomes. And, all this architecture was built at, turn of the 19th century, right? We got Chase Park Plaza. We've got, Lululemon, and we have all of these old buildings and places where we can live. And there's these old, archaeological beauty, but like the interior has been rehabbed to like modern, luxuries. I mean, look at the basilica. Look at the basilica. If you walk inside this basilica, it looks like this. It looks like this. Okay? And if that's not your taste, don't worry. We have a Whole Foods. Okay? So the Central West End has become the single most in-demand neighborhood, debatably, I'll say, in the entire Midwest. Okay? This is our monopoly board. Okay? Now, it's a rare high leverage board in real life because it has two things. It has traffic and it has anchors. Okay, so let's talk about that. We have the anchors that keep the board together, and we've got the traffic running through the board, right? So high traffic equals high rent potential. That's ultimately what you want, is pieces moving around the board paying rent, okay? So here's what we have. Okay, we've got Barnes Jewish and WashU Medical Campus. It's one of the largest medical complexes in the country with over 20,000 employees, 2,000 medical students and residents, and $1 billion in research funding. Okay, this is a healthcare behemoth, all right? Then you've got, we have the Cortex Innovation District. Now, the Cortex Innovation District, I pause because I can't do it justice. It's important to understand that this thing generates $2.1 billion in annual economic activity and $40 million in tax revenue. It's facilitated just shy of $1 billion in leveraged investments in the surrounding area development. It aims to employ 15,000 people at full capacity, okay? And the whole thing was formed in order to harness and harbor biotech and tech in St. Louis, and it's attracted both startups and Fortune 500 companies. Okay, obviously Microsoft has a satellite office here. You know, Nestle Purina has a. You know, you can walk through here and see Fortune 500 employees and startup entrepreneurs interacting together in like this beautiful facility. It added 99 companies last year and currently has, I believe, around 350 companies housed inside the Cortex innovation community. It is an economic, thriving, crazy thing that's happening. So when you look at the Central West End, it has over 16,000 people that live in the neighborhood. It has over 5,000 people that are coming in on transit. Okay. You've got 11,000 people daily foot traffic during the week. You have 22,000 vehicles, okay, on Forest Park Parkway there. And ultimately there's 40,000 daily resident and non-resident traffic moving through the Central West End every single workday. Every single workday. Okay. So you've got traffic. Now, these people are 39 years old, okay, on average, and they have a higher income and education than most. That's who is living here. It is the largest populated neighborhood in St. Louis, okay? Further, it's at near capacity. There's limited new development opportunity. There's nowhere to go. Ultimately, I believe that's kind of why the Grove was able to get built right down south of it. Look, guys, I have inside knowledge. CoStar came out with a report recently, okay, that ultimately documented that new construction pipeline in St. Louis is 1.2% of existing apartment stock, okay? It's one of the lowest in the country, and based on that stat alone, I can tell you that this week, St. Louis received a $14.5 million check from institutional investors that are paying attention to this stuff. I know of another $9 million check that was received for the same reason last month. If you are thinking about real estate and you're looking for supply-demand imbalances, this is one of them. This is that moment, okay? There's also, okay, the occupancy is high. It's at 94 to 95%, and it's not overbuilt, which is why you're seeing some private equity firms start to move in here, okay? You've got the Marlowe that just went in. My neighbor actually built that, and 100 above the park, which is this building right here. This is the Marlowe. So the high-end, expensive, luxury, living rent apartments are getting full, and they're getting full fast. Okay. So now we move into the anchors. Okay. Here's what's going on with the anchors. You've got WashU and SLU, which we talked about. Okay. Then you've got BJC Healthcare, the multi-billion-dollar anchor. Okay, which we talked about. But you've got also this cultural capital. Right? So not only is it a great, vibrant place with a good culture, it's got a bookstore. Did we talk about that? It's got chess, right? Local coffee shops, but it has Forest Park. And we have to take a minute and try to understand the importance of Forest Park. This is the single largest city park in the country, okay? It's larger than Central Park in New York, and it's got golf. Okay, it's got a history museum. It has, 6 miles, just shy of 6 miles trails around the perimeter. You see people every single day, every single morning, afternoon, and night running, riding their bike, playing tennis, all of these things. This is literally across the street. This is across Kings Highway or across Lindell from living in the Central West End. This is a free, included with your rent, green space that is right next door. This is the St. Louis's ranked, art museum. This is Art Hill, where my kids like to sled in the winter. This is where I sledded as a child. And the symphony comes out once a year and actually, sets up a big movie screen, and the community comes together and listens to music and watches a movie with no volume. We've got all kinds of, we've got the jewel box, we've got the balloon race. It's beautiful, it's nature, it's green space, it's huge. And believe it or not, right in the middle, you're not gonna believe this, right in the middle is one of the world's top ranked zoos. It's free. Go see the polar bear on a Sunday by yourself. It's totally free, it's included. And when you live in the Central West End, you can not only go watch a movie, go get a haircut, go to work, go to a world-class restaurant, get your third wave coffee, go to the zoo, and walk home. Okay, you can do all of this in the Central West End. It's a little insane when you start to think about it. Walker, okay, I get it. It's a board. It's a Monopoly board. I get it. What are those 7 steps again? Okay, let's break it down. Here we go. Number 1, buy everything you land on early in the game. Okay, now, these are the 11 properties, okay, that we currently have under contract to close next month, okay? Do you remember this guy? We talked about Kyle at the beginning and his team, and they are working on off-market deals. The person who bought all of these properties that is selling them to us, okay, took 40 years to accumulate them, okay? Not only that, but not only are they selling it, they're selling it to Kyle and the AHM team because they think that this is the right team to carry their legacy for them, to execute their vision of the community and everything that they wanted to see get done. So not only are they selling it to them, but they've also agreed to roll $8.3 million in preferred equity, which is code for debt, if you don't know what that is, so that we can buy it. So ultimately, we're getting over $27 million in real estate value for $4.5 million of equity infusion, okay? It's, 52,000 square feet of neighborhood street retail, 31,000 feet of small office space, 12,000 square foot vacant historic police station to be redeveloped. We've got, 4,000 foot parking lot, 50,000 square foot pay parking lot, which serves the neighborhood and also has some other opportunities that we'll talk about. You can get in all these details. But here's the thing. Number 2, target the orange and red properties. Remember those high traffic properties? Guys, we will own next month when we close on this, all 4 corners of the highest foot traffic intersection in the entire Central West End. Closer to the ground, it looks like this, okay? There are 6 restaurants at this intersection. 6. So do the math on that, including, here I am last week standing in the middle of this intersection. That's my favorite taco restaurant in all of St. Louis right there, okay? So here's what it looks like from a bird's eye view. You can see, these here, all right? So step 3, build 3 houses as fast as possible. That's code for increase the value of what you own. So, okay, anything that's highlighted, these are the properties we're buying. Now, by increasing the value, we have identified out of the 11, there are 8 that have revenue increasing opportunities available right away. 3 of them that I put the circles around, okay, are actual full-blown rehabs that we're going to go in and, do true value added for, okay? So there is immediate revenue increases available and value adds on the majority of the portfolio. 4, use trades to create monopolies. In other words, give up things that you're not using in order to favor building monopolies around the areas that are your strengths, okay? What this is code for here is we have a pipeline of additional properties that I can't really talk about because I don't want anyone seeing this video and going after them. But because our team works in this neighborhood and has built, off-market deal pipeline, we have additional sellers that are interested in selling to us. Some of them are very, very close to the other properties that we're buying right here, okay? And so this is just an example of one of the deals we're closing on. We're raising not only the $4.5 million to buy the initial portfolio, which will, by the way, on the first day, make us the single largest property owner in the entire Central West End, which is interesting in terms of quantity of locations, but also raising $5.5 million for additional expansion, ground up opportunities, and strategic growth, okay? And that's not all, okay? We have number 5, create a mortgage machine. So use leverage to expand organically. Well, look, here's a huge multifamily housing without off-street parking. And here is 1.1 acres of parking that we will own this time next month. Well, it's also one of the only opportunities for ground up construction that is still around in the entire Central West End. And by the way, it neighbors all 4 corners that we're already going to own, okay? Now, we might have 1 or 2 other opportunities. Can't talk about them yet because we're not closing on them, but they're extremely, extremely limited. Now, your step 6, your jail strategy evolves, okay? What that means is manage your properties and build equity, all right? So ultimately, this is the part where once you have gone out and done the acquisition and done the value increase, now you sit back and get out of the fray and manage it properly and let it all build equity, okay? At that moment, this is when we are trying to actually build up the community and increase, the foot traffic and increase the reasons to go and increase the reasons that you want to be there and have all of those things that create true, vibrant neighborhoods. That's the goal, okay? So let's break it down in terms of step 7 is optimized for the grand finale. So I want to show you some projections, okay? Now I did a sample $150,000 invested instead of my normal 100,000, and I'll show you why in a minute. But I want you to just get a sense for what it's going to be like to be in this deal, okay? And you put in 150,000, and ultimately we start to get a little cash out in year 3, 15,000, so 10%. Then a 12% cash out in year 4, 15 in year 5. Starting in year 6 and beyond, the goal is 20% cash on cash returns. Okay, so you can do the math there. The last 5 years you're going to get your money back, and then this is going to be some bonus cash flow, and then we've got the big exit in year 10. Okay, now by the way, there is an optional 5-year extension. We can also cut it short or whatever, but the point is that you can't project out this far. And we've got a 5.37x return, so $150,000 investment would return a little over $800,000 at the end of the decade. Okay, now why do I want to harp on this? Look, when you're underwriting deals, you have to be underwriting to current standards, okay? We can't say things like, we are going to do a really good job with all of the qualitative things that are going to increase the quantitative things. We can't say that we expect that at some point in the next decade that interest rates will go down, okay, which would increase our returns, for example. We can't say that, everything is going to go according to plan or whatever. The point is, this is the base case underwriting with all of the existing realities that exist today. And if you were a victim to investing in multifamily in 2021, for example, the underwriting was everything that was current on those days, which were not sustainable. So, we believe that this is a very good time to invest, but we can't necessarily, put out there a whole bunch of, overly excited, projections. So this is a base case situation. Walker, why'd you put 150? Because I did the math, and if we are lucky enough, and we're not projecting this, we are not offering it, I am just sharing my own thoughts. If we are successful at increasing this 5.4x return to a 6, say, like if things just really work out, or at some point in the next decade interest rates go down, or whatever it is, okay, that we succeed, then that means $167,000 would get you to $1 million in year 10, and then that would be your $1 million real estate retirement portfolio, just as a hypothetical example. Now, I also want to take just a second and compare it to this equivalent investment in the stock market. So you put in 150,000. Now here's the deal. You cannot touch it. The minute you touch your money, you've interrupted the compounding, okay? So even though we know it's liquid, you can't touch it. Okay, if the market like bombs out and you freak out and sell, you're out. So we have to assume, same underwriting model as up there, a moderately aggressive equities only portfolio, 150,000 in, and then you wait 10 years out and you're going to get $340,000. So 2.26x with no tax benefits or anything like that, unless this happens to be in your retirement account. This, of course, starts opening up 1031 exchanges and all kinds of other things that we're not going to go into here. But the point is comparatively, you start to understand why David Swenson and a lot of ultra high net worth individuals start to play in the real estate game. Okay, so this is just one example of the projections. Now, Walker, it's amazing. Oh my God, it's amazing. You've got the board, you've got the contract, you've got the off-market deals. But wait a second. Has AHM done this before? And guys, this is the right question. So let's cover this. They have, okay, and they've done this in Tower Grove South. Okay, this is the MoFo. This is the YO. Those are up and running. This is their next development in that neighborhood. They've done this in the Grove, okay? They rehabbed what is now Urban Chestnut. They put up new construction apartment buildings and rehabbed the whole Grove into what it is today. There's more buildings that aren't on here. We've done this also right now, as we know here at Build Wealth, in downtown West, or what is now called City Commons. AHM acquired 12 urban acres, okay, right next to the new soccer stadium. And these are some of the buildings that they bought, okay? Our first deal at Build Wealth was this Rothschild portfolio. This is the 314 building, the highest mass timber building in the world that is on track to continue to break ground in December of this year, which we are invested in. Super exciting for that. HM also dipped a toe into the Central West End. And this is the Capstone building. And I'm actually an LP investor in this. And I'm also a GP on what's going to be a new ground up construction also in the Central West End. So the Central West End portfolio isn't like we don't participate in the Central West End and now we are. They'd already kind of started in the neighborhood. And so I kind of wanted to show you, like, here's that Capstone building that I just showed you, but in relation to the rest of the Central West End behind it. Okay. And I wasn't smart to think ahead of time about putting our new intersection in there, but it's close. So today, AHM owns 1,100 active apartment units, 200,000 active commercial square feet, and development pipeline on land it already owns is another 900 apartments and almost 200,000 commercial space. Okay, currently they're at $250 million in assets under management, which is 1/4 of Kyle's goal. When I looked at, AHM, and I think about, how I approach the market and how they approach the market, and what it is that, they really do very well. I kind of wanted to break down their approach, okay, in 7 steps, so we can break it down and start to unpack why it is that I have so much confidence in this team and our strategy here, okay? And the first thing is really just that commercial real estate is the best time-tested, risk-adjusted, scalable asset class, okay? So you're talking about real assets that, you're not dependent on some, what would I call it? Like intangible, relationship or intangible IP working out or whatever it is. There's no systems and processes that are necessarily making it work. Of course there are, and we'll get to that. But like the point is there's a hard asset there, okay, that has value, right? And so it's a good risk-adjusted return. Second, multifamily housing starts, okay, are lower than like they've ever been, okay? I mean, like, so this is like new construction. So basically, like all the buildings that have been coming online, there's going to be a massive dip. And so this is that time in the market cycle where investing in multifamily is not popular, but it's actually exactly the time when you make the most money on the rebound, okay? This is when that happens. This was the last time, 09, 011, this was the last time it was unpopular. And by the time we got to 2013, everyone was asking your friends, hey, how come like you got so smart? Like, how did you make so much money in this? Well, this is what it looks like. This is that supply demand imbalance. And maybe that's why BlackRock just bought Elm Tree Funds in St. Louis last week. Okay. So number 2, non-coastal focus reduces volatility and increases returns. Okay. This is something that, it wasn't just made up, right? Like Kyle, for example, and Mikey, another partner in AHM, they both worked on the coast for a decade, right? In the capital markets and in real estate. And ultimately, it's the non-coastal cities that have much more muted peaks and valleys. It avoids the political risks that come with, New York, Miami, Chicago, Chicago, what is that? The mid coast, right? So St. Louis is actually this ultra diversified economy that doesn't exist in other similarly sized cities. You've got education, healthcare, ag tech, defense, beer, right? It's flyover territory, which is code for like it's overlooked by a lot of the big players. And until now, there's been a lot of other places to do what needs to happen here, right? So it's a really great place to engineer, a live, work, play communities and find off-market acquisitions because there's a lot less competition here. There's an abundance of opportunities, and we live here. So ultimately, having the, non-coastal focus and then being able to see the opportunity in St. Louis because we live here was something that just came together naturally. And actually, Kyle, for example, lived in LA and moved back to execute the strategy here for that reason. Dual strategy, value add and ground up together. Okay, so it's not a single, it's not a single strategy. It's dual. It's a dual strategy. Now let me explain something. In business, when we talk about business acquisitions and business growth and all the rest of it, we talk a lot about, multiple expansion and what that does. So when you think about real estate investors in the United States, there's 10 to 12 million individual real estate investors, right? So these are sort of like, I don't want to call them small time. That's the wrong thing. These are people taking risks or whatever, but there's limited resources. They're maybe buying a $2 million building and, doing their thing. But then ultimately, when you look at institutional investors, okay, we've got 300, it's really 300 to 500 true institutional investors in the United States that are out there doing big institutional endowment style pension deals, okay? That's institutional money. And so what happens is these guys don't have enough money to play in what I'll call the middle market or sub-institutional. And the institutional guys, the smallest checks that they even want to write are $10 million. That's a small check for them. If they can't deploy $10 million, it's like not, they don't want to manage it. It's not enough, okay? So there's this sub-institutional gap that exists right here in the middle. And I think the concept that I'm trying to say here is that, like, when you're doing value add acquisitions and you're doing ground up construction, you're able to build that generational wealth both in midterm and long-term methods and be able to truly tackle a neighborhood, which is the next step, which is how do we revitalize entire neighborhoods? Okay. So what I love about AHM is they're really getting in for impact, control, and flywheel, and they're all about revitalizing entire neighborhoods. This way, it's not like we need to find a good deal. Like, oh, I found a good deal. No, this is all about how do we get in there and get all of the information in an otherwise opaque market and, understand what are the value drivers and engineer our own value into the buildings that we're buying and the communities that we're building and the neighborhoods that we're building. Okay? That's what we care about. A lot of these other current people that we're buying from, okay, they're fragmented real estate owners and they can't meet the scale. They can't meet the next level of development and strategy that's needed for something like the Central West End. Okay, they just play too small. And I don't mean this as an insult. I just mean like we're at the next level now. You don't stay a baby, you don't stay a puppy forever, people, right? So, a lot of the people that are on the ground floor commercial, you've got this bifurcated ownership, who've owned the building for, 3-4 decades and don't necessarily understand the highest and best use or don't really have the incentive to do it. So when you sit down and own most of the neighborhood, you say, look, we don't need 4 coffee shops. We're going to put the coffee shop here. We're going to put the pizza there. We're going to put the grocery there. And you start to build and plan entire neighborhoods. That is where city planning and monopolies come in, okay? Lean execution. So this is cool. So what HM does is HM is vertically integrated. And so the partners there, there's one that handles construction, there's one that handles management. And so ultimately what HM truly understands is the same thing the investors understand, which is no one wants to make money on the management and really construction. And so the money is better in the real estate, which is the best time-tested, risk-adjusted, scalable asset class. So all of the people that are partners in HM, even the employees, they control the management, they can control the construction, but they keep the value in the assets. Okay, so they deliberately manage. They do property management at break even. They're more efficient than a third party. They care more. They know who the tenants are. They have a vested interest in who the tenants are. So they have in-house construction management, so they don't have expensive third-party consulting when it comes time to get those deals going, okay? And they focus on maximizing the value in the real estate, which aligns them with the investors, okay? Plus, there's no outside knowledge of the business plan, okay? And so all of that knowledge is kept internally. Next is this sophisticated team and what I call Midwest arbitrage, okay? So here's the thing with the sophisticated team. I want you to think to yourself for a moment about the last time that there was a trend that started in the Midwest that drifted out to the coasts, okay? So think about that for a second. What was that last trend that started in the Midwest? None. There was none because it's never happened. It goes the other way. okay? It goes the other way. And what happens is there's a 10 to 15 year delay between when things happen on the coast and when they eventually get into the Midwest at a realistic, digestible, adopted way, and that's called the Midwest arbitrage. Okay, so there's a lot of people, a lot of businesses. This is like a known strategy, guys. Like all you people on the coast aren't going to believe this, ready? But this is true. This happens all the time. So you have sweet green. You in California, you in New York have sweet green. And I know you have it because every time I'm there, I go, okay? We don't have that here, okay? In St. Louis, where I am right now. We have neon greens, which by the way, is awesome, okay? We also have crispin green, but we don't have sweet greens, okay? These are just people that looked at the trends and then started these companies here, okay? On the coast, you have blue bottle coffee, okay? We don't have that here, okay? We have blueprint coffee, and it's great. You have berries. The coasts have berries. We have Shred 415, okay? It's the same stuff, guys. It just has a different brand. This is Midwest arbitrage. You have Brooklyn. Brooklyn was perhaps the most successful neighborhood revitalization in all of U.S. history. Like that's maybe true, okay? Like it's definitely debatable if you don't believe it. And you know, a brownstone in Brooklyn, you know, whatever, 10 years ago, 12 years ago, was like $600,000, and today these are going to sell for 2.5 million bucks. Okay. Brooklyn was rehabbed. That's what you have, okay? Or maybe like check out this one. Oh wait, that's Central West End. That's not Brooklyn, that's Central West End in St. Louis. Maybe I meant this one. Oh, that's Central West End in St. Louis. It's amazing how they can look kind of similar. Even when I brought our investor relations, Mike Brown, to town, and Kyle and I walked him around the Central West End, he was like, oh, this is like Seaport in Boston, right? So he's from Boston, and so he was like, you could see how excited he got because he was like, gosh, I missed that investment opportunity, right? I was talking with an investor from New York, and she said, God, I missed the Brooklyn opportunity, right? And so the people that have been through these experiences up close and personal can walk this neighborhood and see and experience all of the same characteristics, okay? So look, whether it's Boston or Chicago West Loop or Atlanta or Brooklyn pre-2005, whatever makes sense for you, like whenever you've seen this before, okay, this is what it looks like now. And this is the next wave right here in the Midwest, St. Louis, Missouri. We just need the right team, okay, to execute this plan for us. Okay, last is the edge through knowledge, all right? In every single neighborhood that AHM plays in, okay, they're the largest owner, every single one. They have control. They favor the relationships and the flywheel of being able to build those off-market relationships and get those off-market deals and understand all the players and what's happening. Because they're capital markets consultants, they also have national coverage and understand what's happening across the country. But because we have property management and construction local, we've got inside local knowledge. We know who's paying the rent. We know what the rents actually are. We know what's for sale. We know where people are working, where people are going, where people are spending money, okay? This is the Central West End, and this is one of the most desirable neighborhoods in the Midwest. Let's talk about what Build Legacy is at a high level. Build Legacy is a fund, but it's really sort of a real estate company, all right? There's a finite timeline and dedicated trophy neighborhood focus. The goal is achieving ultimate yield, okay? It's defined as IRR and equity multiple. The goal is 20% cash on cash returns on the second half of the investment cycle. It's a 10-year fund, guys. It's a 10-year fund. Now, a lot of people that get into real estate syndications, they want to hold for 3 to 5 years and then sell it and then go find another one and, you know, pay taxes or not, you know, enroll it and get into another one. If you actually do the math, this is like doing a little bit better at base case than if you did 2 in a row, okay? Or 2.5 in a row. There's an optional 5-year extension we talked about. We're going to acquire and build a $200 million real estate portfolio in the Central West End. Now, there's a 10% preferred return, okay, available in the documents. But we need $4.5 million to close on the original 11 property portfolio in 4 weeks. So for the next 4 weeks, we have a 12% pref that's going out to the initial investors that are going to help us close on the initial portfolio and de-risk it for everybody else. We're targeting a 5x multiple. Look, we're going to have a special purpose vehicle at Build Wealth that invests only in the legacy fund at AHM. But here's what you need to understand. There's 0 fees in the SPV. All of the fees are on the AHM side. And any fees at Build Wealth for me or our investor relations or our team are all negotiated and coming out of AHM's fees. There's no additional fees or double fees or anything like that on top. Just want to make that very clear. This is for anyone who's focused on long-term value creation or short-term gains, okay? And if you are anywhere near St. Louis or want to come visit and walk the Central West End with me or us before you invest, please come. I think you'll be impressed. Okay, we're at a tipping point in the Central West End. We've got rents firming, listings shrinking, supply constrained, okay? It's right now. Structural supply, demand imbalance. So there's no more build, but demand is fueled by the Cortex, the lifestyle, BJC. And then we've got an arbitrage window where we have high rent at a 61% premium, okay? City level rent to price is still favorable and sub $350,000 buy-ins near institutional anchors, okay? If you are interested in joining us, please reach out to Mike Brown. Text his cell phone, okay? Mike and I work very closely together. He's the point person for every investor. He's going to touch every dollar that's coming in to make sure this is the right investment for you. We do have other opportunities that I'm personally invested in as well. And so I want to make sure we get you into the right thing, if anything, okay? You just want to build a relationship, call us, let's get started. Kyle, go ahead and take it from here and I'll move over to the other computer.
Well, hello. Walker, first of all, thank you so much. You did a better job describing us and this project, this investment company that we're creating honestly better than I could. So really the thing that I want to, I just want to take a moment to share a little bit more about who we are at AHM Group, and then maybe dive into a few of the more specifics of what we're focused on doing. So AHM Group is a hyper-focused, hyper-local real estate development company, diversified, vertically integrated in the way that Walker described. We have an affiliated property management company, construction management company, capital markets advisory firm that's in Los Angeles, and then the property ownership and development arm. 3 of the 4 partners are effectively born and raised in St. Louis. The 4th one is a Southern California guy, and he's still there on the capital market side that helps inform us on decision making and capital markets every day, and also learning from our clients as to what's working, what trends are happening on the coast, or in Austin or the other hyper growth markets. And that really gives us a competitive advantage over a lot of our competitors. And so, like Walker said, we really focus on having the edge of knowledge, and knowledge being power. And so we're focused on not just the city of St. Louis, but really 4 or 5 key neighborhoods within the city of St. Louis, and all of these are no further than, say, 3 or 4 miles away from each other. And so everything is kind of building off of each other, and we get economies of scale that way as well. So the most exciting project probably that I've undertaken thus far. I live in the Central West End. I walk past these properties all day. A few years ago, we were introduced to a gentleman named Pete Rothschild, who is the seller of this portfolio, and we transacted on another 3 properties in 2023. And through that, Pete and myself built a pretty solid relationship. And so, he's retiring. He's in his late 70s at this point, and he and I got together one day, and fortunately, he shed a tear, literally, and said, I'm ready to move on, and can't think of a better person. If we can come to an agreement of a normal price point, a market price point on this 11 unit or this 11 property portfolio, then we'd really love to make the transition happen and protect the legacy that he's worked on for 40 years. And in order to do so, he agreed to reinvest that $8.3 million of preferred equity at an 8% coupon that allows us to really use the $10 million that we're capitalizing this investment company with to help expand that and grow that over the next several years, and leverage the 10 million in a way that we wouldn't otherwise be able to do. It would require about $13 million to acquire this property today, where interest rates are, and a reasonable loan to cost, which we're capitalizing the portfolio with a 60% loan to cost loan initially. And so this is the most kind of nebulous thing that we've done thus far. Normally, we raise capital project by project and have identified a property or several properties that we're going to execute on a very specific business plan. And this is the first case in our 7 years of being in business of AHM Group where we're saying we're going to start a hyper-focused real estate investment company that's focused on one specific neighborhood, and that is the Central West End. And we're very fortunate to be able to seed it with these 11 properties that we're obtaining from the seller. And then through our network, we already have 3 properties identified that we would move to acquire relatively quickly after we close the fundraising round. And then the business plan from there is to recycle the cash flow distributions and make further acquisitions, and hopefully compound this growth while also distributing cash flow in a few years, and maximize the ultimate average cash on cash distributions over a 10 to 15 year period, and also focused on equity multiples. IRRs matter, but over a 10 to 15 year period, IRRs are very difficult to maintain at a high level. But we're focused on achieving effectively hitting a 2x equity multiple every 4 years and approximately a 20% IRR. Why don't we just run through the portfolio briefly? So there are 11 properties. They're all essentially mixed use in nature. The exciting part about it is that we have several. There are 4 that are very light value add and more operational improvements. There are 3 that are heavier value add, where we're making capital improvements and as well as operational improvements. And then there are 2 that are more ground up development focused, or one is ground up development and one is using historic tax credits to renovate a 1904 built police station a few blocks from the core portfolio and also from where I live. So that is essentially the business plan. This entity is really the parent entity. So 5% of the capital comes from AHM Group. 95% of the capital comes from limited partner investors. We then make essentially 2 different tracks of investments. So the first would be the 11 property portfolio that would be acquired by Rothschild Central West End Portfolio LLC. That's where the seller comes in with the 8.3 million of preferred equity. And then the remaining, so then it's a little over $4.5 million of invested capital by the legacy fund. And then the remaining 5.5 approximately million of cash equity, about $1 million will be held on hand for reserve capital, and the other $4.5 million approximately would be funding future acquisitions that include not just total equity for projects that would be under, say, $10 million, but also the co-GP or the GP position, actually the GP position of larger projects, which would be the 433 to 435 North Euclid parking lot site that's a little over an acre, half a block north of the McPherson and Euclid intersection, and then the additional acquisitions. So it's really a bifurcated execution here underneath, with 2 kind of sub entities, if you want to think of it that way, underneath the parent entity, which is the legacy fund known as CWE Legacy Portfolio LLC. And Walker, you did a great job of explaining all of the demand drivers and the neighborhood itself and the why. And so I think that we should really focus maybe on, say, 2 of the key properties. And
Yeah, I had the same thought. Yeah, maybe just pick a couple, 1 or 2, and just walk people through it. And
yeah, and so while we get there, the This is the list of the top 25 employers in the St. Louis MSA, which has approximately 3 million total people. And number one, BJC Healthcare is headquartered a half mile south of the portfolio. Wash U is in the same location and then a mile west also for their key, for the main campus. Boeing Defense has several hundred employees in Cortex. SMM Health has within, it's just under 2 miles. They have two additional hospitals and a medical school that's a part of St. Louis University. So there are a total of 4 level 1 trauma teaching hospitals within a 2 mile radius, 2 within a half mile, and then 2 within 2 miles. And so we have, I think that's 6 of the top 10 employers within a 2 mile radius of this portfolio. And that helps drive these charts. So this is the projected asking rents over the next, this is a historical chart over the last decade, and then the next 5 years projection. This is for multifamily, and the top chart is for all property types. And then both population growth as well as income growth, but more specifically income growth. So St. Louis is a really interesting story because, you know, we've been doing this for a while, raising money from a lot of individuals outside of St. Louis. And they say, like, I just have never thought of St. Louis as being any sort of, you know, well-diversified economy with highly educated workforce, highly skilled workforce. So over the last 10 years, there's been a compound annual growth rate of incomes of 5.6%, but over the last 5 years, it's 8.8%. And in large part, that's due to Boeing Defense, the healthcare sector, ag tech, and biotech, and then just the medical industry as a whole. And this is a really, you know, it's outperforming most top 20 MSAs in the country, and it's a market that not many people think of as being investable. There are 4 properties at this intersection. This is the key intersection. Euclid East Condos, which was gutted by a fire in 2022. The seller needed to renovate the entire property. So we're essentially getting an 1896 built mixed use project that just had $8.5 million invested into it to complete a gut renovation where there are 7 ground floor commercial spaces and 14 apartment units on the second floor. Every single thing is brand new, and the purchase price is $8 million. 100% occupied across the board, below market rents on the multifamily side. And the seller does an excellent job across their portfolio and managing it and managing tenant relationships, but they don't own enough multifamily units today in this neighborhood to truly understand what market rents are. And they also utilize a third-party property manager. And that's where we step in and take a look at the rent roll and say, okay, you know, some of these rents are spot on, and other rents, you know, we'll have a specific rental rate increase projection. And then just also on an operational efficiency side, but also some of those units in the up-down building need to have capital improvements made, while the Euclid East is just below market rents. Euclid Hall is actually the seller's office is right here on the corner. And this whole intersection is his baby. This is what he worked 40 years to assemble. And this is also, this is about a 95% leased and occupied building today, long-term tenancies. The average retail, ground floor retail tenancy is over 10 years. And then it's essentially the same thing on the office side as well. So we'll plan to make specific investments into the second and third floor office space, help convert smaller offices into larger offices, have a longer term tenancy expectation than even today, and that will further drive stability as well as rental growth. Let's see, those are really the 2 that I think are best reflective of the portfolio, because Euclid East is mixed use multifamily and ground floor commercial, and Euclid Hall is mixed use office on floors 2 and 3 and ground floor retail. What specific questions do you think I should answer now, Walker?
Well, you know, Kyle, I've got a hard question for you.
Yeah.
And that's, you know, I think that, look, like, one of the reasons why I think this is such a great opportunity for us is that AHM has been running this playbook in this neighborhood, next neighborhood, the next neighborhood, in a building by building format, as you've
Yes.
underscored, right? And so it's like people will come in on the first building, and then it's like, okay, here's the second building, and they're like, well, wait, should I be in the first building or the second building or the third building, or which one should I be in? And then it just gets like, you're like, their investments are competing with each other, right? Instead of like, going into the whole thing. And so this is allowing people, to get in at the ground floor and, participate as an LP and also a co-GP in some of these opportunities and move in with a portfolio right away. It's a wonderful arrangement. But the sort of like risk or question that, I think would pop up in people's minds are like, gosh, I wonder, is there anything in that portfolio that is maybe just getting thrown in, because like it's low value and like, they don't really want it or we don't want it, and it's just sort of getting tucked in and like, thrown in the bag across the table. Are there any assets, in this portfolio that give you hesitation or worry, or things you don't necessarily want, but you're going ahead and picking them up anyway because it's coming as a package deal? And how are you thinking about that?
Yeah, there are no specific assets that I perceive as being particularly risky, and especially during underwrite, they underwrite just fine. It's more that
Yeah.
they're non-core assets to the portfolio, and
Mm-hmm.
over time, we would look to exit those, but not immediately. It's not as though we're acquiring them and then we're going to split it up and make money that way. It's more, it will be strategic in nature. So the first would be, there's a single tenant triple net property at 6 South Sarah Street, and that has a brand new lease. It's a 5-year lease, brand new operator, and it was actually an acquisition of a currently operating restaurant space that is pretty storied, called Scottish Arms. And so,
Yeah.
the single tenant nature, that's almost like a private credit play rather than an equity, appreciation play. And so our focus there will be season the asset a bit, make sure it's performing well. As rates compress, then cap rates should also compress. And at that point in time, we'll be patient, sometime between, 12 and 24 months in, I would see us exiting that at say a 20 to 40% premium over what we're paying for it today. And then the second would be 449 North Euclid, which is just a block north of Euclid and McPherson. And that is a 10,000 square foot mansion that's been broken up into about 8 office spaces. And, it's for anybody, who's gone to a chiropractor or a therapist or, another medical professional that would office out of, say, like a room. And there are 8 or so, and they're all clustered in the same building, or there's one big office space, but then, they have a master lease and then they subdivide it into 8 or 10 different physician rooms or therapy rooms. Like that's what this is set up to be. And so that's another non-core asset. It's also less than $1 million in value. And, we would look to exit that kind of in that same 12 to 24 month range.
Mm-hmm. Copy that.
Yeah.
It's
But there's nothing, there's nothing risky per se. My favorite part about, I have a lot of favorite parts, so I should stop saying that. But
Yeah.
the other reason that this is really exciting is that we would be buying this portfolio and looking to acquire other real estate assets during a time of high interest rates. And that means that not many people are looking to acquire the properties, and we should be able to execute on purchases that would be below market and make really good, essentially expand our buying power. And that is something that while others are unable to buy, it's a little counter-cyclical. And I think that that's how we'll maximize the value over the, 10 to 15 year period.
Mm-hmm. Kyle, look, we're out of time. I know it's your wife's birthday, and you said to me, Walker, if I'm not off the phone at 5:25, I'm gonna hang you upside down and beat you. We're coming up on that very rapidly. I looked you right in the eye and said, yes, no problem, and thought to myself, okay, 5:30, but it's time to go. But like we've got one question here, which what's the probability of sustainable rent growth over 10 years? Dallas was in a similar spot 5 years ago, and now we're seeing rent declines. I mean, I kind of feel like we spoke to that, but I'm not familiar enough with Dallas, or that what specific submarket that
Yeah.
is. I think Are you familiar or want to speak to that?
Yeah. So Dallas, Dallas is a top 10 market. That means that there are, dozens, if not 100 or more institutional investors or,
Hmm.
family office investors that are active. Dallas has been, over the last 20 years or so, Dallas has been the market that actually has been delivering probably in the top three every single year in terms of additional units coming online. They like can't build enough, and maybe now they've built too much, but and that's a COVID era hangover. When interest rates are 3% or real rates are zero, then people are going to buy more or build more than potentially they would otherwise. One of the So this is an excellent question. So St. Louis isn't immune to that per se. There was an enormous amount of units that were delivered between 2022 and 2024, and then you look at the development pipeline, and it's zero. So the construction pipeline from now through mid-year 2026 is, to your point, I mean, it's less than 1.2% of the housing stock across the entire MSA, and it's less than 300 apartment units in the entire city. And we're a part of half of that that's planned, and that's in the
Yeah.
downtown West City Commons market. So yeah, it's an excellent question. We in St. Louis are really, you know, it's it's good and bad. It's good that we're a perpetually undersupplied market, and that's because institutional equity investors have only started to come into the market over the last, like, since 2015 or so. And so over the last 10 years, we saw a steep compression in cap rates, and trades were, everything was trading at a much higher value, much lower cap rate. And that hasn't slowed down. It's only increased. And you see the political risk in states like New York and California. And California, I think, is starting to change that with what Gavin Newsom just signed. But you have Mamdani coming into New York saying we're going to cap rates, rental rates, and it really that's when you start to. We talk to institutional equity investors have only started to come into the market over the last, like, since 2015 or so. And so over the last 10 years, we saw a steep compression in cap rates, and trades were, everything was trading at a much higher value, much lower cap rate. And that hasn't slowed down. It's only increased. And you see the political risk in states like New York and California. And California, I think, is starting to change that with what Gavin Newsom just signed. But you have Mamdani coming into New York saying we're going to cap rates, rental rates, and it really that's when you start to. We talk to institutional equity investors have only started to come into the market over the last, like, since 2015 or so. And so over the last 10 years, we saw a steep compression in cap rates, and trades were, everything was trading at a much higher value, much lower cap rate. And that hasn't slowed down. It's only increased. And you see the political risk in states like New York and California. And California, I think, is starting to change that with what Gavin Newsom just signed. But you have Mamdani coming into New York saying we're going to cap rates, rental rates, and it really that's when you start to. We talk to institutional equity investors every day, and they say, like, we're not investing in California right now, and we're absolutely not investing in New York. That's not to say that investment isn't taking place, but that helps drive additional investment into markets like St. Louis, and that's why we're closing the acquisition with a $14 million equity check from an institutional investor.
Awesome.
This is their first deal in St. Louis.
Kyle, we have two very quick questions here from participants, and everyone else who has a question, keep them, and maybe we'll do a Q&A in a couple of weeks. Arshia says, can you take advantage of bonus depreciation as an LP investor in this fund?
Yes, you can. The other thing that is really exciting about St. Louis is the fact that the land basis is so low. So unlike a city like LA or New York or Chicago, even, or Austin, Nashville, the land basis isn't 40% of your basis, and the improvement's 60. It's more like 5 to 10% of your basis. And actually, on a ground up deal that we just broke ground on, that's 18 unit townhome, it was 3% of the total cost basis. And so you don't even need to utilize the bonus depreciation. You utilize the standard 27.5 year depreciation schedule, and you have negative net income essentially in perpetuity without the bonus depreciation. But yes, we can take advantage of that should we need to. We can do cost segregation and then bonus depreciate.
Yep. Um, Bobby in Charleston, it's more of a it's not a question, but a demand, which is
Sure.
he's going to invest, but he wants tea time with you on your next Kiowa trip, which is the shirt you're
That
wearing.
sounds good. Well, in Charleston, what is Kiowa, an hour south of Charleston? Yeah, let's do it. Let's do it,
Yeah,
Bob.
let's do it. Let's do
Yeah.
it. Kyle, listen, I think
Or come to St. Louis and we'll play golf here.
yeah, at Forest Park, and yeah.
Yeah.
Um, listen, thank you so much for your time. Thanks for this opportunity. I know we've been, talking about this for months on end. It's hard to believe it's finally here. And here we go. So listen, guys, we will, get in touch with Mike Brown. Get into the portal. If nothing else, we've got I should have said that earlier. We've got an offering memorandum in there. We're going to have more docs coming soon. There's an interview with me and Kyle that was lightly edited that goes through some of this. And so all of the docs will be getting in there. There's materials to review, get in there pronto. And then also Mike Brown is on the call. If you look in the chat, you can, the portal is buildwealth.investnext.com, and getting a hold of Mike either via text or with his calendar are both in chat. So let's get those meetings on the calendar, get those soft commitments in if you have interest so that we know who you are. I think this first 4.5 million is going to go pretty quickly. It's a super exciting opportunity, and anyone who is in a position of fund in the next 4 weeks is going to get that 12% pref, which is a very nice boost. So Kyle, any final words from you?
No, thank you.
Great.
Thank you, Walker, for doing a great job. And thanks everybody for being here.
And all right, guys, we'll see you on the inside. Thanks, team.
Thank you.